Uh, Luando Franklin is my name. I'm the lead tutor and Chief Executive Officer at FCL Accountants Tuition Center. I have vast experience in lecturing, over 20 years of lecturing, and I welcome you to FCL Accountants Tuition Center YouTube channel. In today's video, I will be discussing the following issues, and this is relevant for all basic accounting, that is financial accounting, for ACCA, for ZICA, for CIMA, and other courses. The focus will be on the types of transactions, and that will be the cash transactions, credit transactions. I'll also look at the common terms used in accounting. We'll also look at the double entry concept or the dual concept. Therefore, I'll get started with the types of business transactions. We have two types of business transactions. That is the cash transaction and the credit transactions. So there are two types of transactions. So when we talk about a transaction, we are talking about the buying and selling of goods. Business transaction involves the buying and selling of goods, for which payment can be either in cash or on credit. That is, both receipt and payment could be either by cash or on credit. So now I'll start with explaining the cash transaction. The cash transaction involves the procurement or the selling of goods and services for which the receipt or payment is made immediately, and that is cash on delivery. And now we look at credit transaction. Credit transaction involves the procurement or the selling of goods and services for which cash receipt or payment is made in the future at the specified dates. So I have explained the two types of transaction. So now I'm going to explain the common terms used in accounting. There are a number of common terms that are used in accounting. So number one, we can refer to the capital. Capital refers to the resources that are used to set up a business. It includes both cash and other resources that are used to set up a business. That will be capital. Number two, we have assets. Assets are resources that are owned by the business. We have two types of assets. We have the current assets and non-current assets. Current assets are those assets that will be used in business within a period of 1 year. They are principally meant to be converted into cash or other assets. So we have a number of examples of current assets. We have receivables. We have the cash in hand. We also have cash at bank. We also have repayments. So these are examples of current assets. Receivables are those individuals and companies who owe us money for buying goods on credit. So those who buy goods on credit from us are referred to as receivables. Cash in hand, that is the money that we have in the business. Cash at bank, that is the money that we have with the bank. Prepayments, these are amounts paid in advance for services. For example, rent paid in advance. It's a current asset because we have not yet enjoyed the service. So those are the examples of current assets. Now we go to non-current assets. Non-current assets. The non-current assets are those assets that are owned by the entity, which are used for more than 1 year. And these are not meant for selling. They are meant for generation of revenue to be used on a permanent basis. So we have a number of examples there. Number one, we have land and buildings. Land and buildings is an example of a non-current asset. Land and buildings is an example of non-current assets. Two, we have motor vehicles. Motor vehicles, then we have fixtures and fittings. Fixtures and fittings. Then we have plant and machinery. So we have plant and machinery. That's an example. Then we have 5 equipment. So these are the examples of non-current assets. So non-current assets are meant to be used in business on a permanent basis. They are not meant for sale. Now we can move to liabilities. Liabilities, we have 2 types of liabilities. We have current liabilities. We have non-current liabilities. So current liabilities are the amounts that we owe other companies or individuals. These are due for payment within 1 year. Current liabilities are amounts that we owe other companies or individuals, and they are due for payment within 1 year. So we can have examples of current assets. So the current liabilities. 1, trade payables. Trade payables are those amounts that we owe suppliers for the goods that we bought on credit. Trade payables are those amounts that we owe suppliers for the goods we bought on credit. Number 2, we have bank overdraft. The bank overdraft is a current liability. Bank overdraft, we are owing the bank for overdrawing our account. We've been allowed to overdraw our account. So that is the amount that should be paid to the bank within a period of 1 year. We have I want you to understand here, we also have short-term bank loans. Short-term bank loans. Short-term bank loans. Short-term bank loans. Short-term bank loans are also current liabilities. And then we have amounts owing. Amounts outstanding is the same as amounts unpaid. Is the same as amounts owing. Is the same as amounts accrued. So amounts outstanding, amounts unpaid, amounts owing, amounts accrued, and amounts due, they mean the same things. We have enjoyed the services, but we have not yet paid for them. So those are amounts outstanding. For example, wages due. So now we can look at the non-current liabilities. Non-current liabilities are amounts due in more than 1 year. Amounts due after 1 or more years. Amounts due after 1 or more years, they are non-current liabilities. We are owing, but the payment will be made after 1 or more years. Examples include long-term loans. Long-term loans are examples of non-current liabilities. So now we move to the double entry concept. The double entry concept. The double entry concept here, I want you to understand. Double entry concept is also known as dual concept. Before I explain the double entry concept, I want to demonstrate that an account has two sides, the debit side and the credit side. So an account gives details of the transaction that occurred. So each transaction has got its own account. That is an account. The debit side of an account is the receiving side, and the credit side is the giving account. So now let me explain. The double entry concept states that for every transaction, there must be two accounts involved. For every transaction, there must be two accounts involved. The account that is receiving and the account that is giving. Therefore, the concept is debit, the receiving account, and credit, the giving account. That is the double entry concept. So now we are going to look at the question which I'm sharing on the screen here. We have the 2.1 question that we do together. So we have an account to be debited, account to be credited. Number one, bought office machinery on credit from D Isaac Limited. So here we ask ourselves, which account is receiving and which account is giving? Here we are receiving the office machinery. So you debit machinery. And here who is giving? D. Isaac. Debit D. Isaacs Limited. So the machinery, maybe we can make it much more clearer here. Account debit is credit. So we have A who debit the machinery account because that's what we are receiving. And we are going to credit the D Isaac Limited. That's what is giving the machines. So debit the receiving account and credit the giving account. We go to B. The proprietor paid a creditor, C. Jones, from his private fund. So C. Jones is receiving. So debit C. Jones, who is receiving. Proprietor is the owner of the business. When he uses his private funds, that is capital. So capital is giving, capital account. C, a debtor is a person owing us money, that is the receivable. A debtor and folks paid us in cash. So if he's paying us in cash, the cash account is receiving. And the N folks is giving credit. N folks who is giving. Then D, repaid part of the loan from P, etc. by check. Repaid part of the loan from P, etc. by the check. So we are who is receiving? P, etc. is receiving. So we debit P, etc. Who is being represented by the loan? Debit loan account. We are paying by check. The bank is giving credit, the account that is giving, which is the bank. We go to E, retain some of the office machinery to D, Isaac. So D, Isaac is receiving the machinery. We are returning. D, Isaac Limited. And there, O is, we are giving away the office machines returns account. So credit office machines returns account. Then we have F. Under F, we have a debtor who is a receivable. A debtor only pays us by check. So we are receiving. So the bank is receiving. So the bank account. The bank account we have there, we debit because we are receiving. And the N lien is giving out. Credit N lien account, the giver. And we have G. Under G, bought van by cash. We are receiving the van. So debit the van account. And credit the credit cash, which is giving out the money. So that is the explanation of the double entry concept together with the questions that we have answered. So in the next series, we'll be looking at the correction of errors, types of errors and correction of errors, types of errors and correction of errors. That will be the next series. Please be on the lookout. Ensure you check the video, which will be available very soon. And today we'll end here. Thank you for joining us in this presentation. May God bless you.